When individuals retire, there are four main tax traps that we see retirees fall into unexpectedly all of the time. Now, while individuals think when they retire, the tax solution and tax planning is supposed to get more simple, it actually in many cases becomes more complex because you have things in the mix now like Social Security, you have Medicare premiums, you do Roth conversions, you have RMDs from retirement accounts. There's a lot of tax planning involved. The four main tax traps that we're going to be covering today for retirees is how RMDs can create tax surprises. Number two, how Social Security is taxed. Number three, how Medicare premiums are affected by income. And number four, a lack of tax-specific distribution planning. The first tax trap we're going to cover revolves around the RMD requirement, or require minimum distributions from pre-tax retirement accounts. So once retirees reach certain ages, the IRS requires them to start taking distributions out of their pre-tax accounts, whether they need them or not. So right now it's either age 73 or 75. The tax trap this creates is this is all taxable income coming to that retiree. It could cause that income to be subject to higher income tax rates. It could cause their Medicare premiums to increase. It can cause more of their Social Security benefit to be taxed, or it could make them ineligible for certain tax deductions or tax credits they were previously receiving. A common example might be we have a husband-wife that retired from the state and they both have pensions. So they retire at 55 and they're like, hey, Mike, the pension income is more than enough to meet our expenses. I know we have these retirement accounts with the state, but we're not going to have to touch those. They're all pre-tax dollars. We're just going to let them grow. And then when we're RMD age, we'll start taking money out of them. The problem with that strategy might be, even though the pensions are enough and they can essentially leave those retirement accounts alone, those retirement accounts, let's say there's $500,000 in them when they're age 55 and they don't hit RMD age until, let's say, 75, maybe those retirement accounts grow to $1 million or $1.5 million over that 20-year period. Once they hit RMD age, they're going to have their pension income. They'll have turned on Social Security at that point, and then the RMDs are going to stack up on top of that, which could be $40,000 plus per year, depending on what those accounts have grown to. With prudent distribution planning, like we're going to talk about later on, it might have made more sense for that couple to start taking distributions every year, starting at age 56, out of their employer-sponsored retirement plans, realize some of that income over that 20-year period to essentially slow down the growth of those pre-tax retirement accounts, thus reducing the future RMD amounts. The second tax trap is how Social Security is taxed to retirees once they begin receiving their benefits. So under current tax law, and I say that because there's motion in the works right now by the Trump administration to change the rules that essentially the Trump administration wants to make Social Security benefits tax-free at the federal level, which under current rules, that's not how it works. The way it works under current tax rules is, depending on your level of income, a different proportion of your Social Security benefit may be subject to federal taxation. Here is a quick summary of what proportion the Social Security benefits are taxed at the federal level for 2025. So there's essentially three rates. Either you don't pay any tax on your Social Security benefit at the federal level, there is a 50% taxable level, and there's an 85% taxable level. So for any single filers below $25,000, they do not pay any federal tax on their Social Security benefit. Joint filers, tax-free, is below $32,000. For the 50% threshold, so 50% of the Social Security benefit subject to taxation, single filers between $25,000 and $34,000, and combined joint filers between $32,000 and $44,000. And for individuals in the top tier, where 85% of their Social Security benefit is taxable at the federal level, single filers above $34,000 and joint filers above $44,000. The tax trap lies in income triggers of sometimes one-time events that happen during the year. Let's say a retiree sells a stock at a gain and it boosts up their income, where before they were paying no tax on their Social Security, but then it bumps them up into the 85% of their Social Security benefit is non-taxable. That's a tax surprise to them. Maybe they surrender an insurance policy that creates income taxation. They take distribution from a pre-tax retirement account. So retirees just have to be aware of where the thresholds are. Otherwise, all of a sudden, a tax-free Social Security benefit could then become a taxable benefit. Tax trap number 3 is probably the one that surprises most individuals and sometimes even tax preparers that don't know the Medicare premium rules. So Medicare premiums, when you reach age 65 and you're all on Medicare, not a lot of people realize those Medicare Part B and Part D premiums are income-based. So even some people are surprised to know that there's any cost, but the cost is actually sizable potentially when you get to that Medicare coverage. Now, the way Medicare premiums work is they look at your income 2 years prior to determine what your premiums are going to be in the current year. So in these tax traps, if a mistake is made in the current year, that retiree doesn't find out until 2 years later because of that Medicare look-back delay. Here is the Medicare Part B premium table for 2025. And as you look at the table, if you're a married filing joint and you make under $212,000 per year, the Part B premium for each spouse is $185 per month. But as soon as they go above that threshold, the next tier up, $212,000, $266,000, those Medicare premiums go up to $259 per month, which is a sizable jump. And this is exactly where this RMD situation that we talked about in the first tax trap can come back to haunt them with Medicare premiums. Is they might have been okay between 65 and 75, but as soon as those RMDs are required to begin, and let's say they have a $50,000 or $60,000 RMD, that can cause them to trip over these Medicare thresholds. So not only are they paying higher taxes on the RMDs from the IRAs, but also they're paying more for Medicare for essentially the rest of their lives. Tax trap number 4, which is usually the root cause of all these other tax problems, is just a lack of distribution planning leading up to retirement and in retirement. So a lot of times when we're consulting with clients, we're planning out the next 20 or 30 years of their life in an effort to say, what do you need to meet your expenses? Here are your various asset buckets, and how do we take distributions from those various buckets over time to minimize your tax liability over the rest of your life? That can often include processing sizable distribution from pre-tax retirement accounts early in the retirement years. It can include processing Roth conversions. It may include delaying filing for Social Security to put off those income tax liabilities until a later date. It may include developing a tax plan for surrendering permanent life insurance policies in the right year. It may include evaluating pension and annuity elections, or a tax plan for realizing gains on a taxable investment account and then forecasting out what the RMDs are going to be at age 73 or 75. Having one of these robust distribution plans can save a retiree thousands of dollars in taxes over their lifetime that otherwise would have been paid to the government without planning, and it also helps them to avoid some of these surprising tax falls later on in life. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.